Hello and welcome to our follow-up of the Q&A session that we had in our recent event in London for the insurance space. We're going to take the benefit of having Giorgio Baldassarri here today with us. Giorgio heads up our analytical development group, and myself, Gustavo, Tella, will be hosting today's discussions. So without much further ado, Giorgio, I'll start with the first question.
Sure, yes.
How do political factors impact the model, or the models that we've been developing?
This is definitely a very relevant question. They do have a very strong impact. One case that we can mention very recently is probably the case of the issues between Russia and Ukraine. The way that we capture them from an analytic point of view in our quantitative models is in two ways. Directly through the assessment of a country risk score that is directly impacted obviously by these geopolitical issues, because it captures the risk of a company operating in a certain country, and in another dimension through the so-called sovereign score that actually is indirectly impacted by socio-political events, as one can imagine, because if there are issues, this can affect the willingness or ability of a sovereign to repay its own debt, and thus to impact also the companies operating in such a country.
So you mentioned Russia and Ukraine. So how quickly do you think those changes can impact the model?
We tend to update these scores on a quarterly basis, but we're thinking actually to update them on a more frequent basis. We need to think a bit about this.
Okay, and since we're talking about geopolitical risk, I have to ask, how much does the sovereign rating of a country impact the overall score of a company?
This is, again, a very interesting question, because in our quantitative models we use scores, and we take an idea from the rating side that they distinguish between a so-called sovereign rating, long-term foreign currency, so the ability of a rating to of a sovereign to repay its own debt obligations in foreign currency, and then the transfer and convertibility assessment. So the idea behind this actually assessment is the fact that certain countries, certain sovereigns, prefer to join together within a monetary union, and as such they tend to follow the policies defined by an overarching structure. And for companies operating in countries affected by a monetary policy, it makes more sense, especially for corporates, to look at this as a kind of consistency check about how creditworthy they can become.
And can they ever exceed the sovereign ceiling, or the sovereign rating ceiling?
Yeah, there are cases like probably the case of the European Union is the best example that I can make very quickly. Greece is a country, part of the European Union. They got a sovereign rating that is, or a sovereign score in our case, that is very harsh for them. But companies operating there, they can exceed this sovereign score, and because they are benefiting from the monetary union actually within the European Union. So definitely yes.
Okay, thank you very much, Giorgio, for your time, and this is all we had time today, and stay tuned for the follow-up of this video. Thank you.